Hi everyone, good evening. You're watching The Money Show on ET Now. I'm Mubina Kapasi. This is the show where we talk about all of your finances. We help you understand all the latest news and updates coming in and make sense of it, especially within the context of your money. So let's start off by talking about taxes. Reason being that, in case you've forgotten, the Finance Minister has allowed up until the 30th of June, that's basically 20 days from now, or rather under 20 days from now, to make tax-saving investments. So all the people who've been a bit tardy when it comes to tax management, guess what? The FM has allowed you another 20 days up till 30th of June. Plus, if you're worried about social distancing, everything is now online. So I really don't know what you're waiting for. We will be talking and guiding you through the entire process of tax-saving investment right here on the show. We'll also be getting a brief gist on essentially things like what are the new income tax returns like, what more disclosure do they want, and also very interesting topic, and that is how do you ensure that your bank continues to not deduct TDS on your interest if you are eligible for something like that. Many a times, individuals do not require for their bank to deduct TDS on incomes like interest, etc., either because they do not fall in the tax bracket or because they've made the right tax-saving investments. You have to submit a Form 15G or 15H, but with the social distancing norms that we're in the midst of, how is it possible to do that? So lots of questions and queries. We're going to get all of these answered. I have with me Mr. Ved Jain, former president of the Institute of Chartered Accountants of India, or the ICAI. Mr. Jain, really appreciate you joining us today on The Money Show and on ET Now. Let's start off with the very first topic, and that's the additional 20 days granted by the Finance Minister for making tax-saving investments in FY20. Yes, Mr. Jain, there are still a couple of individuals who've really not made their tax-saving investment. May come as a shocker to you as well, but I guess people are simply to be honest, they either may be facing a cash crunch or they've simply just been downright tardy. So, Mr. Jain, your key words, your advice, how do you utilize these 20 days now to efficiently make the right investments so as to manage your taxes?
Mubina, you will recall that we had a lockdown on 23rd March, and the last date for making investment is 31st March. So obviously, the Finance Minister, the Government of India, was compelled to extend the due date for making investment for seeking exemption. And she was kind enough to grant an extension of 3 months, meaning thereby that whatever investment you were supposed to make till 31st March, you can make investment till 30th June 2020. And you will get the benefit in the financial year 1920. As we all know, there's a lot of deduction which are available under Chapter 6A, particularly under Section 80C of rupees 1,50,000 on account of the Provident Fund, on account of contribution to life insurance premium, on account of the purchase of NSEs, PPF, etc. So these are the long-term saving which everyone indulges into. And in view of the lockdown happening, the last date is 30th June. So what my message is, in case you have not been able to make this investment, or you have not been making payment of mediclaim or account of the scholarship, etc., on account of donation under Section 80G, etc., you can still do before 30th June. If you do it before 30th June, you will be entitled to claim the deduction of this amount against your income for the financial year 1920. All those salaried peoples, they may be happier to claim this deduction because they are supposed to reduce the income. At the same time, people who are in businesses, it can be a good tax planning because I consider your income in 1920 financial year may be a reasonably good income because there was not much lockdown except in the last 7 days. But the current year, financial year 2021, is going to be difficult. And many of the business people may not individually, which sole proprietor do carry on business, they may not be having such income to have savings also and to claim deduction. So it will be ideal in case they have not completed their quota of what we say threshold limit of 1,50,000 rupees under 80C, 50,000 rupees in 80C CD and regarding NPS or donation, etc. It will be ideal to make the payment right now before 30th June and to claim the deduction in the financial year 1920, the due date of which filing return has also been extended to the 30th November. So you pay now by 30th June 20 and you claim this deduction in the financial year 1920, the due date of which is 30th November 2020 now. That's a big benefit which is there.
Mr. Jain, since you brought up that bit on donations under Section 80G, just a follow-up question over there. We had the PM Cares Fund wherein you could contribute, for relief on the COVID front and the COVID pandemic, and you could claim a deduction under Section 80G. However, was that applicable for contributions made only prior to 31st March and it would be only for FY20?
No, let me be very clear. There is no such condition. 80G is a donation to anyone. Whether you contribute to Prime Minister Relief Fund, whether you contribute to Prime Minister Care Fund, whether you contribute to Chief Minister Relief Fund, or any temple or which has a 80G certificate. And if you make contribution by 30th June 2020, you will be eligible to claim this deduction in your financial year 1920. An option is available to you. If you have made the payment after 1st April 20 and before 30th June, you have an option to claim this deduction in the last year, that is 1920. That's a flexibility which has been given. And many people, as you see, many corporates have contributed a substantial amount of money to the Prime Minister Care Fund and claiming exemption and deduction in the financial year 1920, which is an exemption available to you. That's the issue. Let me clarify, the exemption for Prime Minister Care Fund, Prime Minister Relief Fund, etc., is 100%. It is not 50%. In some of the other trust institutions, temples, etc., or those charitable societies, etc., the exemption is 50%. But for Prime Minister Care Fund, Prime Minister Relief Fund, this exemption is 100%. So if you contribute for the cause of the coronavirus, for which the Prime Minister Care Fund has been set up before 30th June, you can claim 100% deduction against your income in the financial year 1920. That's the right. You have the right of that.
All right. So even if you make the payment in April, May, June, we make your contribution to the Prime Minister Care Fund in April, May, June, you can still claim it under Section 80G, and that to 100% for FY20. I think that's an important clarification. Okay. Now, Mr. Jain, many of us are familiar with the Form 15G, 15H, which we have to physically go to the bank and ask them that, look, I do not want to I don't want you to deduct TDS on my FD interest or any other interest that I am earning from the bank, because I'm making my tax saving investments or I do not fall in the taxable bracket. However, there's no question of us physically walking over to the bank at this juncture. So, is there any relief provided by the government over there, or, what are the online options as well available for me? Is every bank essentially, giving that option that, okay, you can just submit this form online?
Let me clarify two issues. As I said, the lockdown happened on 23rd March, and thereafter the form is supposed to be submitted in the first week of the quarter. And that was supposed to be submitted in April, because your Form 15G and 15H is valid for the financial year 1920. So it is 2021 where the issue has arisen. And there the CBDT has come out with a circular on 3rd April 2020 that whatever the form you have submitted 15G and 15H for financial year 1920 will continue to be valid for the first quarter, that is April to June 20. So there was no need to submit a new form 15G and 15H for the first quarter, because as I say, 15G is applicable to all persons, 15H is applicable to senior citizen. And the only difference between 15G and 15H is that in 15G, no tax will be deducted on interest, etc. But your income should not exceed the maximum amount which is not chargeable to tax, that is 2,50,000. But 15H can be submitted by the senior citizen, even in case where the income exceeds the maximum amount, but there is no tax payable because of the deduction you have. You may have some exemption, etc., available as a senior citizen. So these are the two flexibility given. Now coming to the second quarter, which is there, now you need to submit the new form by first week of July, so that the bank do not deduct your TDS later on after the 1st July also. For that, both options are available. The law provides that it can be submitted online also, it can be submitted physically. If the bank is close to you and you have been visiting it because the lockdown has been lifted, you can walk into the bank and submit the form. But if you want to submit online, by and large, all banks have now gone online, and there is on their website and website, there is a column available. There is a field particular, you go in, fill in, particular, submit your bank account number, submit your PAN number, etc., and you can file this form online also. That flexibility and facility is still available by and large on all banks' websites.
Okay, all right. Well, you know what? Let's just move on and take on board some questions and queries. And we've got quite a few actually lined up for you, Mr. Jain. First up, Vimal Sharma writes in to us, my father, who is 90 plus years old, expired in April 2020. He was a central government pensioner. Now, he wants to know how can he file his income tax return for AY 2020-2021. So, basically March 2020. That's fiscal year, financial year 2020. He's expired after the end of the financial year. Mr. Jain, how would you advise Vimal?
See, Movina, for Mr. Vimal Verma, the issue is very simple and clear. Income Tax Act provides a complete mechanism in such a situation. In the case of a death of a person, the legal repairs are liable to the same responsibility as the person deceased was. There is a specific section 159 which puts a responsibility on the legal heirs to comply with all the obligation to make all the payment of taxes what the deceased was supposed to do. In the present case, what I will suggest to Mr. Vimal Verma is to file the return of the financial year, that is 1st April 19 to 31st March 20, with the due date has been extended to 30th November 20, as a legal represented legal heir. All he need to fill in the return of late Mr. So-and-so through the legal heir so-and-so. Whatever the income his father as pension was having, whatever the interest income he may be having from some bank account, fixed deposit, or some other investment, etc., he should declare. Whatever the TDS has been deducted, he should claim, and whatever. This income need not be included in his own income. It will be a separate assessment in the hand of the father only, because he is filing the return on the legal evidence. All the taxes has whatever he deducted, he need to pay, and whatever the further is required to be paid, now Mr. Vimal Verma should pay. The only exception which is there is Mr. Vimal Verma liability will not exceed the total amount which his father has left in his hand. So in case the amount left, I will believe in this case particularly will be more than the tax liability. Pension income by and large, TDS would have been deducted. So Mr. Vimal should comply. I may put a further rider, not only of the financial year 1920, since his father has died in April 20, so he will be maybe required to file the return from 1st April to the date of the death also, because he would have got certain income. In case income is below the threshold limits, then there is no requirement. But in case the income is above the threshold limit, or some tax has been deducted, which he want to get a refund, etc., he can still file the return. That return will be filed the next year. So he can do the compliance. He steps into the shoes of the father as a legal representative.
And this will be not just for March 2020, but also March 2021, because he was, alive for those few days in April 2020. So he is basically then, obliged to report whatever income is there in April 2021. So Mr. Vimal Sharma steps into the shoes of his father and, acts as a representative on behalf of the deceased, which, Mr. Sharma's case is, of course, his father. Okay, well, let's move on and take on board another question. Mr. R.V. Rao says, I am the Karta of my HUF with my wife as the member and my two daughters as co-partners. Recently, a villa has been purchased by the HUF, and to complete its interior work such as false ceiling, cupboards, kitchen, etc., my daughter, who is the co-partner, would like to give it an amount of 25 lakh rupees. His question is, would such a gift from a co-partner to an HUF have any tax implications, attract a gift or clubbing provisions either to the HUF or the donor? Mr. Jain, what is your understanding of what the Income Tax Act provides for this?
It's an interesting question and maybe of interest to all, I believe, because these type of common questions come in the family. So let me clarify. The law clearly says when you receive a gift from anybody, it is chargeable to tax. However, in case you receive a gift from a relative, that is not chargeable to tax. And relative has been defined in section 56(2), under which provision this income is taxed. So there it has been defined that which type of relatives are defined. If you receive a gift from spouse, you receive from brothers, sisters, etc., so those gifts are exempt. And one of the exemption is when an HUF receives a gift from a member of the HUF. Now, the daughters being the member of the HUF, she being contributing and giving gift to the HUF, so that gift will not be liable for tax in the hand of the HUF and will be exempt. So he need not worry about that. The gift received from the daughter for doing the interior or the completing the house, that will not be chargeable to tax in the hand of the HUF. I may further add that in this case, the law further provides that in case any income arising from such gift, then the income arising of that gift will be taxed in the hand of the donor, not in the hand of a donee. We have another complex provision which we call Section 64(2), whereby any member of the HEF gives a gift to the HEF, and from that money or that gift, some income arises to HEF. That income is to be taxed in the hand of the contributor, that is a donor. Now, in case this house is rented out and some rent is received, proportionate amount of the rent, which is proportionate to the 25 lakh rupees gift of the total investment made by the HEF, will be taxed in the hand of the daughter, not in the hand of the HEF. So that's a complex law. I believe in this case, the situation will not arise because the daughter is making a gift to the house, which probably will be self-occupied. So there will be no income on that account. So there is no complexity arising thereon. Gift will be exempt. However, in case you rent it out later on, a proportionate amount of the rent in the proportion to the investment made or account of gift may be chargeable to tax in the hand of the daughter, not in the hand of. So there is no double taxation. In case that happens, then daughter will pay the tax on that proportionate part and HEF will not pay.
Okay. All right. So very simple. If a co-partner is giving money to the HUF, it's not essentially taxable. So Mr. Rao can carry out the villa work with that monetary gift given by his daughter, who's also a co-partner in the HUF. Okay, Mr. Jain, we would have loved to take some more questions with you, but we're a little short on time. So I'll let you go at that. Thanks so much for joining us. It's always a pleasure having you on board and, getting your expertise and opinion on various tax news and tax matters.